Let's analyze Tesla's stock today, especially considering the incredible 50% increase recently. By the way, I recorded a video about this, which you can watch. In it, I discussed the reasons why such an increase could happen, and it indeed occurred. We based our analysis on options analysis, derivatives, and volatility. Today, we will look at the same aspects, especially as we see that the volatility of Tesla stock is skyrocketing. The volatility smile also provides us with some interesting insights. Finally, we will look at trading volumes as they indicate a price of $300. Could it be that the stock will rise to $300 after the report? Again, we will go through everything in detail now. Let's start from the beginning. Tesla's stock has risen by 45% recently. This is a significant increase, and Tesla's earnings report is coming up soon. We need to watch it closely to see how well cars are selling, the margins, and everything else. Now let's look at the volatility. It will tell us what is happening. As we can see, the average volatility of Tesla stock is 50%. This is still high, but at the moment, volatility has risen very sharply, especially at the nearest strikes. At the nearest strikes, volatility reaches 80%, and at more distant strikes, the nearest expiration dates, volatility also reaches 80%. As we can see, at more medium-term strikes and expiration dates, volatility is between 65% and 70%. This is a normal situation. Such a sharp increase in volatility is primarily due to the upcoming report, because volatility always rises before a report. Now let's look at the volatility smile. As we can see, the volatility smile is generally directed at both the downside and the upside at closer expiration dates. This is a normal situation because anything can happen after the report. However, if we look at longer expiration dates, volatility towards calls doesn't increase much, while it significantly increases towards puts. This is also normal because investors and traders who buy stocks must hedge their risks. That's what I do, not only manage stocks but also hedge my risks. Therefore, put options generally cost more than call options, partly because investors and traders buy put options to hedge their risks. Now let's look at implied and historical volatility. As we can see, these volatilities are actually at about the same level. The gray line is historical volatility, while the white line is implied volatility. Especially with longer expiration dates, implied volatility tends to spike. This, of course, is related to the upcoming earnings report. This situation is perfectly normal when both volatilities converge. I generally recommend paying attention to this because trading volatility can be easier than trading the underlying asset. Why? Because volatility always tends to revert to its historical mean. If you had bet on this, you could have made a significant profit as volatility returns to its historical values. How to profit from this, you ask? Following an old reliable tradition, I will show you one of the interesting strategies suggested by artificial intelligence. Let's build a strategy for September and assume that volatility will increase by 15%. The AI will suggest various strategies with different levels of complexity. Let's look at one of them. The AI suggests buying one put option with a strike of $240, buying one call option with a strike of $245 for September. Additionally, sell one put option with a strike of $240 for October, and sell one call option with a strike of $245 also for October. Friends, this is an extremely complex strategy. It involves both buying and selling options with different expiration dates. This is a very intricate strategy and requires real management. If you can manage such a strategy, you can earn a significant amount of money. As we can see, the profitability looks like this. If Tesla's stock price rises, we earn money. If Tesla's stock price falls, we also earn money. However, if you manage these positions well, your results can be even better. Now, let's return to the most crucial market factor, the trading volume of options. What does the trading volume tell us? We see an enormous, almost catastrophic volume of 57,000 contracts concentrated at the $300 level. This is an incredible volume. Unlike the volumes at $250 and $240, which are mainly concentrated for this week, the $300 volume includes not only weekly options, but all options available across all expiration dates. What does this indicate? This indicates a lot, my friends. Let's first look at the $300 level. Recently, Tesla's stock was at $270, and moving to $300 is just a 10% increase. This isn't much because, as we've seen, Tesla's stock has risen by 15% in a few days. At one point, Tesla's stock even increased by 20% in just 2 days. So there's nothing extraordinary about reaching $300, especially since we already touched $300 in July 2023. Exactly 1 year ago, on July 20th, we hit $300 during the earnings report. Could history repeat itself this time? It's quite possible. But what could happen? We consider hypothetical scenarios. I'm not saying it will happen, just discussing how it might unfold. Tesla's stock might momentarily rise to $300. I suspect there will be a significant resistance at this level. Given the colossal volume of call options, breaking this resistance level will be extremely difficult, if not impossible. Remember, there's no certainty in the stock market, but based on my experience and knowledge, I can predict that we won't surpass $300 next week, no matter what happens. However, this is just my personal opinion. We'll see if this prediction holds true. Overcoming $300 seems unlikely, but whether we'll reach it is harder to say. If we do reach it, a pullback might occur, followed by a second attempt to break through. There's also a chance Tesla's stock could just fall. The volumes are significant, but again, nothing is guaranteed. Now let's look at the next volumes at $250 and $240. There's nothing unusual here. Tesla is roughly within these ranges, and $240 shows strong support through put options. Currently, we have stopped around the $240 level, so these levels should not be ignored. I always try to highlight this, and as we can see, we've paused at these levels. Now let's turn to the most interesting part, the market forecast, especially for next week. If we look at the forecast immediately after the earnings report, the market suggests that Tesla stock will be in the range of $230 to $235 next week. So Tesla's stock is currently in these ranges, maybe slightly lower, primarily because the market does not yet have the necessary information. When the earnings report is released, new information will allow the market to reassess the risks. Looking at the forecast for the end of August, the market predicts Tesla will be between $225 and $235. Again, this indicates a slight decline. For the end of the year, Tesla is expected to be around $200 to $215, suggesting a more significant drop. This prediction is likely related to the anticipated recession. I believe a recession is imminent, even though indices are near their historical highs. Yes, we've seen a small pullback, but it's within the margin of error. We'll continue to monitor this situation. The key point I always emphasize is that I don't predict price movements. I don't know where the stock will go. My main goal is to manage positions wisely. If you learn to manage positions well, you'll always profit. Let me show you a strategy that can help you earn money regardless of the stock's direction. Whether the stock rises or falls, you can profit. If Tesla's stock rises to $285, you can earn $21,000. If it rises to $300, you'll gain $15,000. If it drops to $200, you'll also make $15,000. No matter where Tesla's stock goes, you profit. This strategy involves selling options. However, if the stock experiences a sharp rise or fall, you could lose money. This approach requires a comprehensive strategy. If the stock rises above $320, you could start losing money. But by analyzing the volatility market, options market, and identifying support and resistance levels, you can build a strategy to minimize risk. Nevertheless, the most important thing I always emphasize is managing positions wisely. So even with this position, you need to sell options at certain points, buy options at others, hedge your risk, and only then can you secure consistent profits. I always show you 3D volatility charts, where all the information about volatility and options is concentrated. Professionals often use these charts to form sound strategies. Now let's get back to Tesla stocks and what's happening here. Everything will depend on the earnings report. It will be very interesting to see. If the report is good, it could give Tesla a significant boost. If the report is not favorable, Tesla could drop sharply, just as it rose. I believe that sooner or later Tesla will surpass its historical high. When exactly this will happen is hard to say, perhaps even after a recession. But eventually I think it will happen. So if you are a long-term investor and believe in this stock, you can simply hold and wait. However, I wouldn't recommend using leverage because you could lose a lot of money if things go wrong. Also, I remind you that I recently started a new experiment. In it, I show how I manage positions. The account is entirely real. I explain and demonstrate how I form a portfolio. You can watch this video, leave comments, and if you have questions, email me. Good luck to everyone.